Hey traders, and welcome back to Alpha Market Meridian, your daily institutional-grade market analysis hub where we don't chase noise. We decode order flow, map multi-timeframe structure, and turn raw market volatility into calculated, high-probability profit every single trading session. If you're new here, make sure you subscribe, hit the notification bell, and stay locked in, because we cover 8 major asset classes every single day, deliver precise key levels, actionable trade setups, institutional sentiment shifts, and the exact macro drivers that most retail traders completely overlook. Today we are diving deep into Euro to US dollar, one of the most liquid, most sentiment-sensitive, and policy-driven pairs on the entire Forex board. And right now this pair is sitting directly on a make-or-break resistance zone that will dictate price action for the rest of the week and set the directional tone for all Euro-linked assets across the board. What you're seeing right now on your charts is not random noise, it's institutional order absorption at a critical supply zone, and if you fail to recognize this structure, you will get caught on the wrong side of the coming breakout or breakdown move. Stay focused, stay disciplined, and let's break this down layer by layer exactly how institutional traders analyze every single candle, every moving average alignment, every MACD momentum shift, and every fundamental headline that's currently driving Euro to US dollar price behavior. Let's start by laying out the immediate market context so you have the full picture before we dive into technicals and trade setups. Over the past 24 hours, the US dollar index has held steady above its near-term support zone, refusing to collapse despite minor risk-on moves across global equities. Eurozone economic data prints have come in mixed, not strong enough to justify a sustained Euro rally, yet not weak enough to trigger a sharp downside sell-off. European Central Bank official commentary has remained neutral and data-dependent, refusing to lean hawkish or dovish in any explicit way, which leaves the euro trapped in policy limbo with no clear directional catalyst from the central bank side. Meanwhile, Federal Reserve rhetoric has maintained a cautious higher-for-longer narrative on interest rates, keeping yield differentials tilted modestly in favor of the US dollar and capping any meaningful bullish extension in Euro to US dollar. This macro backdrop is creating a perfect range-bound compression right into a major technical resistance level, and that compression always resolves with a sharp, impulsive move that catches retail traders off guard. Right now, price is stalling heavily at the pivotal 1.1750 zone, and this single level is the line between continuation higher and a full bearish fake-out reversal that will trap late buyers at the top of this short-term rally leg. If you are holding longs, looking to enter longs, or even considering short positions here, you absolutely cannot. Ignore the institutional weight sitting directly at 1.1750. Now let's move into full multi-timeframe technical analysis, starting from the lowest timeframe and working our way up to weekly structure. Exactly how professional institutional analysts stack confluence for high-confidence trade decisions. We begin with the 60-minute chart, the intraday roadmap that dictates entry timing and immediate order flow behavior. On the 60-minute timeframe, price has staged a clear recovery rally off recent swing lows, pushing steadily higher until it directly tests the 1.1750 horizontal resistance barrier. At this key level, buying momentum has immediately dried up. We see repeated rejection candles, upper wick formation, and inability to close above the supply zone on any intraday timeframe. Looking at moving average alignment on the hourly chart, the MA20 is sloping upward supporting short-term bullish momentum, the MA60 is flattening out acting as dynamic underlying support, while the MA200 remains sloping sideways showing no strong long-term trend bias on this lower timeframe. Where we see real divergence is in the MACD oscillator. The MACD line has failed to push above the signal line at resistance, momentum is starting to contract, histogram bars are shrinking into negative territory, and we are developing a clear bearish momentum divergence right at the exact resistance zone. This is one of the clearest warning signs you can see on any intraday chart. Price makes a higher high into resistance, but momentum makes a lower high, signaling fading buying pressure and incoming institutional selling interest. Retail traders chase the higher high buying the breakout hope, while institutions are distributing sell orders directly into this liquidity zone. This is the classic bull trap setup we watch for every single week, And right now euro to US dollar is displaying every single textbook signature of that exact pattern, moving up to the 4-hour chart, our primary swing trading time frame where we identify trend structure, major support and resistance, and lasting directional bias. On the 4-hour time frame, the short-term rally has recovered deep into a previous consolidation box, now testing the upper boundary of that range right at 1.1750. Moving average structure here shifts noticeably more bearish. The short-term MA20 is still elevated beneath price supporting the recent bounce, but the MA60 and MA200 are both sloping firmly downward, creating a strong dynamic resistance overhead that aligns perfectly with the horizontal 1.1750 level. Confluence like this is what institutional traders live for. Horizontal supply merging with long-term moving average resistance creating an extremely high probability rejection zone. The MACD on the 4-hour chart is sitting near the zero line, neither strongly bullish nor bearish, which confirms we are in compression mode ahead of a large impending move. RSI on the 4-hour time frame has climbed into overbought territory above the 65 threshold, meaning bullish momentum is stretched and due for a cooling off phase or a full retracement lower. When you combine overbought RSI, converging dynamic and horizontal resistance, plus fading hourly MACD momentum, the odds heavily favor rejection over a clean breakout higher. Any breakout attempt above 1.1750 without sustained volume and follow-through will almost certainly be a fake-out designed to grab retail buy-side liquidity before dropping back down into the range and eventually targeting lower support levels. Next we analyze the daily chart, the time frame that defines the intermediate trend and sets the overall bias for days and weeks ahead. On the daily time frame, euro to US dollar has been stuck in a broader sideways consolidation range for multiple weeks, bouncing between well-defined daily support and daily resistance with no sustainable breakout in either direction. The recent bounce from daily support has brought price back up toward the middle to upper portion of this range, once again testing the 1.1750 pivotal mark. Daily moving averages show the MA20 curling slightly higher, suggesting short-term bullish recovery, but the MA60 and MA200 remain in a clear downtrend, keeping the longer-term intermediate trend bias to the downside. Daily MACD has lifted slightly from lower levels but has not managed to break into strong bullish territory, remaining neutral and showing no powerful shift in underlying trend momentum. This daily structure tells us we are not in a fresh bull trend. We are simply inside a large range rally into resistance, and the path of least resistance remains sideways to lower unless we can secure a daily close firmly above 1.1750 with follow-through buying the next trading day. Until that happens, every rally into this zone is a selling opportunity for institutional swing traders, not a breakout buying opportunity for retail. Stepping up to the weekly chart, our big picture macro trend time frame that filters out daily noise and shows where major liquidity pools and long-term trend lines sit. On the weekly time frame, euro to US dollar remains trapped within a multi-week consolidation band, with price rotating around key weekly moving average levels. The weekly MA20, MA60, and MA200 are all aligned in a neutral to slightly bearish formation, with no clear breakout trend established in either direction. Weekly candle structure shows repeated rejection at upper resistance zones and repeated holding at lower support zones, confirming prolonged range-bound market conditions driven by balanced central bank policy expectations between the European Central Bank and the Federal Reserve. Weekly MACD is flatlined near the zero line, no strong momentum in either direction, which perfectly mirrors the macro reality. No extreme hawkish or dovish surprise from either central bank to push this pair into a fresh multi-week trend. All of this multi-timeframe analysis stacked together gives us one crystal clear conclusion. Euro to US dollar is in short-term bullish momentum running directly into heavy confluent resistance at 1.1750. Momentum is fading on lower timeframes. Higher timeframes remain neutral to bearish, and the setup favors rejection and retracement far more than a sustained breakout higher. Now let's dive deeper into the fundamental drivers that are reinforcing this technical setup, because technicals never operate in a vacuum. Macro flows, interest rate differentials, risk sentiment, and institutional positioning always validate or invalidate technical structure. Over the last 24 hours, U.S. Treasury yields have stabilized after minor pullbacks, maintaining the interest rate advantage for the US dollar and limiting euro upside. Eurozone headline inflation prints have not delivered any upside surprise that would force the ECB into a more hawkish stance, keeping rate expectations anchored and preventing Eurobulls from gaining fundamental traction. Global risk sentiment is mixed, with equities seeing mild gains but no strong risk-on surge that typically weakens the safe haven US dollar. Geopolitical headlines remain in the background, not providing any fresh catalyst to drive safe haven inflows or outflows in meaningful size. Institutional positioning data shows hedge funds and large asset managers have been scaling back bullish euro exposure near current resistance levels, reducing long positioning and adding to short exposure right at 1.1750, exactly where technical rejection is taking place. ETF. Capital flows also show steady inflows into US dollar exposure and modest outflows from euro-linked assets, confirming the institutional flow narrative aligning perfectly with our technical analysis. We also have to apply the cross-asset correlation rules we follow strictly at Alpha Market Meridian, because no major currency pair trades entirely alone. Euro to US dollar is highly correlated with pound sterling to US dollar, and right now cable is also facing its own major resistance zone, unable to stage a clean breakout higher. This synchronized resistance across both euro and pound-dollar pairs confirms broad US dollar underlying strength. This is not euro-specific weakness alone, it's dollar resilience holding across all major counterparts. Gold and crude oil are trading neutrally with no sharp inflation-driven move, which removes another potential catalyst that could shift euro sentiment. Bitcoin and US equities are mixed, not staging a strong risk-on rally that would normally pressure the dollar, keeping the entire Forex complex stuck in range-bound behavior. All these cross-asset correlations confirm there is no fresh fundamental fuel to push euro to US dollar above 1.1750, making technical rejection the highest probability outcome by a wide margin. Now we move into the core actionable section every trader needs. 3 fully defined trading strategies tailored for 3 different risk profiles: conservative low risk, standard moderate risk, and aggressive high risk setups, all with exact entry zones, precise stop loss levels, multiple take profit targets, clear invalidation rules, and strict risk reward parameters you can apply immediately to your live account. This is where we turn analysis into actual profit, no vague predictions, no ambiguous levels, just exact institutional style trade planning. Strategy 1 is the conservative high probability setup, designed for traders who prioritize win rate over aggressive targets, small position sizing, and only enter when price gives clear confirmation of rejection at resistance. For this conservative play, we wait for a confirmed close below intraday support following rejection at 1.1750. We require a 60-minute candle close below 1.1740 with a clear bearish upper wick testing the 1.1750 resistance zone. Once that close prints, we enter short on the open of the next candle. Stop loss is placed safely above the entire rejection structure at 1.1770, far enough to avoid minor wick stopouts but tight enough to preserve capital. First take profit target sits at the immediate hourly dynamic support zone around 1.1715, locking in partial profits and allowing us to move stop loss to break even once this level hits. Second take profit target extends to the recent swing low confluence zone at 1.1680, a major structural support where buyers previously stepped in aggressively. The risk-reward ratio on this conservative setup exceeds 2 to 1, one of the safest high confluence trades you can take on euro to US dollar right now. Invalidation rule is simple. Any clear daily close above 1.1750 cancels this bearish setup entirely, and we step aside to avoid fighting a fresh bullish breakout trend. Strategy 2 is the standard moderate risk setup, ideal for swing traders who want solid risk reward and are comfortable waiting for a confirmed breakdown of near-term support rather than just resistance rejection. For this setup, we watch for a decisive break and 60-minute close below the immediate support shelf at 1.1730. This close confirms selling pressure has taken control, buyers have failed to defend near-term support, and the path is open for further downside extension. Entry is taken on the breakdown close, stop loss placed just above the entire resistance cluster at 1.1760 to absorb normal market noise. First take profit target is the psychological round number level at 1.1700, always a magnet for price action and order flow. Second take profit target extends to the 4-hour structural swing low at 1.1655, a major demand zone where previous bullish reversals originated. This setup delivers a risk-reward ratio above 3 to 1, perfect for standard position sizing and swing holding over 1 to 3 trading days. Invalidation occurs if price reclaim 1.1730 back to the upside with a strong bullish candle close, signaling the breakdown was a fake-out and selling pressure has faded. Strategy 3 is the aggressive contrarian setup, reserved only for experienced traders who understand countertrend entry rules, use very tight position sizing, and accept higher short-term volatility risk. This aggressive play enters short directly on a test of the 1.1750 resistance zone, without waiting for confirmation breakdown. We enter on intraday price touching 1.1748 to 1.1750 zone, placing an extremely tight stop loss just above structure at 1.1765 to limit downside exposure immediately. First take profit target sits at the hourly MA20 dynamic support around 1.1720. Allowing quick partial profit booking. Second take profit target aligns with the key structural support at 1.1680, mirroring our conservative target zone. This aggressive setup offers the earliest entry and best potential entry price, but it carries higher probability of minor wick stopouts, which is why we strictly limit position size to a fraction of normal trade allocation. We emphasize repeatedly, this strategy is not for beginners, only for disciplined professional traders who master countertrend timing and strict position management. If price breaks above 1.1765 and holds, this aggressive setup is immediately invalidated. No second guessing, no holding losses hoping for a reversal. You exit instantly and wait for the next clean setup. Now we cover non-negotiable risk management rules that separate institutional profitable traders from consistent retail losers. Rules we enforce on every single trade regardless of asset or setup quality. First rule. Never risk more than 1 to 2% of your total trading capital on any single EUR, USD trade or any individual asset trade. Your position size must always be calculated based on your stop-loss distance and your fixed allowed risk per trade, not based on how confident you feel about the setup. Confidence never overrides mathematical risk control. Second rule, reduce position size significantly ahead of high-impact Eurozone or US economic data releases. Never hold full positions into major headline risk that can trigger sudden gap moves and spike volatility that wipe out stop-loss levels. Third rule, never chase breakout moves immediately into resistance or support. Always wait for candle close confirmation to avoid fake-out traps designed to liquidate retail order flow. Fourth rule, once your first take profit target is hit, always move your stop loss to break even to eliminate all remaining risk on the trade, letting the market run with house money for the second target. Fifth rule, do not overtrade this range-bound market. When price is stuck between major support and resistance, only take the highest confluence setups and stay patient for clear resolution instead of forcing multiple low-quality entries. These risk management rules are the foundation of long-term trading survival far more than any technical pattern or strategy ever will be. Let's now recap all key price levels you need to mark directly on your charts right now for Euro to US dollar immediate and weekly trading. Major critical resistance sits firmly at 1.1750, with secondary overhead resistance at 1.1796, the recent swing high that would be targeted on a true bullish breakout. Immediate intraday support lies at 1.1730, followed by psychological support at 1.1700, then major structural demand at 1.1680, with deeper secondary support down at 1.1655. These levels are your roadmap for every entry, exit, and invalidation signal this week. Watch price reaction at these zones closely. Rejection at resistance confirms bearish bias, hold at support confirms range rotation, breakout above or below clears the path for the next impulsive leg. As we wrap up today's full institutional analysis, let's summarize the core takeaway simply. Euro to US dollar short-term bullish momentum has run directly into heavy multi-timeframe confluent resistance at 1.1750. Momentum is fading on lower timeframes. Macro fundamentals offer no fresh breakout catalyst. Institutional positioning is leaning short at this zone. And 3 clearly defined trade setups are ready for execution for all risk profiles. This is not a time to chase late long entries into a bull trap zone. This is a time to wait for confirmation, follow the institutional order flow, and trade the highest probability resolution. Now it's your turn to join the community analysis. Drop in the comments below whether you are bullish or bearish on euro to US dollar from current levels. Write down your personal key support and resistance zones. And let's build a collective institutional trading mindset together. I read every single comment and engage with every serious trade plan you share. Make sure you are subscribed, turn on all notification alerts, because tomorrow we break down the next critical macro event that will shift yield differentials and directly impact euro to US dollar, pound sterling to US dollar, gold, and the entire dollar complex. This is Alpha Market Meridian, where we analyze like institutions, trade with discipline, and turn every market wave into consistent profit. Stay disciplined, stay patient, and we will see you in the next session.